Today's format is going to be like this. We'll dive on to oil right away. I'll teach you what to look out for when it comes to investing into commodities and especially into oil. Next, I'll address recession risks as well as what is its impact on commodity prices. And last but not least, I'll be touching on palm oil. I'd like to address that question also. Have I been buying more palm oil stocks or not? So if you're curious, continue watching on. Hi guys, welcome back. Let's dive onto things, and this is a big chart to start things rolling. If you look, there are many lines over here, but follow me through. I'll explain each and every one of them. The first one that I'd like to highlight to you is actually the pink line at the bottom. What exactly is that? That's actually Microsoft. Now, I put this in purposely to show you that Microsoft back then was already a tech giant. It was already invincible in its software business. It was already a dominant player with a strong moat. But that period, Microsoft showed underperformance in terms of share price. It corrected also when the global financial crisis erupted somewhere towards the tail end of 2007. That goes to show that internet companies are not invincible, because a lot of times the message we get on social media as well as investment causes, they always tell us about software, internet and stuff. I'd like to re-highlight again that things are not permanent. What was a winner previously may not be a winner moving forward, and what was a loser previously can eventually become a winner. Then beyond that, you'll see on the top purple line over there, that actually is the ticker PSCE. That is actually Invesco Small Cap Oil and Gas ETF. I'm using it to depict general small oil and gas players in terms of their share price. What happens to it when oil price moves? You see that it's quite clearly more volatile and possibly outperforms big cap oil stocks. That is in the shaded green region. That is XLE, SPDR Energy ETF. But subsequently from 2014 onwards, when oil price trended down, PSC, which depicts small cap oil and gas stocks, actually lost way more than big cap stocks. Next to highlight is the yellow line over here. This is actually the oil price futures. And last but not least, the blue line just below it, that is actually USO ETF. I've actually traded USO very long time ago. And if you're new, you might be thinking, this ETF is good, it can give you the exposure. Then this segment, listen up a bit also. You see over here that the blue line severely underperformed the yellow line, correct? It's pretty obvious. In fact, after 2009, it was flat all the way. Now the curious question is, if this blue line is meant to track the yellow line, then why is it underperforming that badly? The simple reason is because of this contango effect. Contango effect is when an ETF which buys futures contracts have to roll each and every month's contract moving forward, and then every time they roll, they actually incur a small cost to things. If you look in terms of month-to-month or day-to-day basis, the tracking with the spot price is pretty accurate. But when you compound differences over months rolling, you realize that the outcome is very different. So you buy ETFs which invest into futures contracts, be very careful. And later I'll be extrapolating what is happening right now on the market with this, because there is a reversal of things. From what I briefly read, USO has made certain adjustments. But the quick conclusion that I'd like to share with you is that when you invest into commodities and, for example, into oil, it's much better to own oil companies rather than the oil price itself or oil ETFs, because those are meant for trading. When you invest in companies, that one is much easier to go long term. That is something Warren Buffett has done, and he's recently increased his stake in Occidental Petroleum, most recently again. Now let's zoom in to 2008, because that was global financial crisis, correct? Let's compare XLE against Goldman Sachs in terms of share price. What you'll see is that Goldman Sachs share price actually peaked in October 2007. That was in line with general index. And bear in mind again, 2007 was global financial crisis. Goldman Sachs was a king of the banking sector. Energy, as you can see over here, was about the last to fall, and that was when everything else already sold off already. Energy was still making new highs. But the main thing is this. General market sentiment can sour something with strong fundamentals also. And as you can see, XLE, which depicts again big cap energy companies, also came down subsequently, losing about 50%. At this point of time, you'll be thinking, if market turns south, everything would lose. Why not sell everything? Even commodities is not going to be a safe haven. Why not sell everything? The question is, we do not know whether it would fall or not. Because everything I'm suggesting to you is it could fall. But again, nobody knows for sure. And if we are not too sure, then if we stay in the outperforming sector and ride it out, isn't it a much safer option than exiting the market? Then eventually it did not turn out as bad as it seemed like. So we are always never sure. What we need to do is to pick outperforming sectors or pick quality companies to invest for a longer term. This chart again reinforces finance sector actually was an underperforming sector. After being a market darling for many years, this could very well happen to technology. Let's fast forward to today. In the green zone, you still see XLE. And right now, I'm plotting it against the light blue line, which is PSCE, Invesco Small Cap Energy ETF. You realize that the small cap again is outperforming the big cap, quite simply because market liquidity is less. A small increment in profitability would change the company drastically. And you'll see two more other lines. The first one is the purple line that depicts again the oil price. And what you see above it now is USO, which is the oil ETF. How come USO is outperforming the oil price itself? Quite simple to explain. Now it's a reversal from 2008. Now commodities are in a backwardation phase. Crude oil futures investors like USO actually have a positive rollover, whereby every time they buy a new futures contract, the spot price is actually lower and they actually generate a positive return. So you compound that over time, you realize that USO will outperform even though it's meant to just track the oil price. But again, we don't know when the conditions will reverse. So the bottom line is oil price is not for investing, it's better suited for trading. Coming to here, if you have questions, leave in the comment sections, and if you have already benefited from some useful information, help me smash the like button so that we can reach a bigger audience together and share with them important concepts in commodities. Now let's address the million-dollar question, which is when will commodity price actually crash or correct severely? I've mentioned in the previous tutorial, later I'll leave towards the end of this, that demand destruction can come from a few sources. First is when consumers, industrials or retail start to use less. Demand drops, then price will drop, correct? The second, which is a bit more permanent, is when there are alternatives into the market permanently, such as battery technology, such as solar, etc, etc. These can create again a drop in terms of demand, so price drops also. But the biggest concern or the biggest impact to making oil price and many commodity prices drop drastically is actually this R word, recession. Recession is when there is a loss of manufacturing, when there is a slowdown in industrial output, and when there's a more conservative projection in terms of demand for oil and other commodities. That's why you realize that at every recession point, oil price in this chart over here drops significantly. In year 2000, after the dot-com bubble crash, oil price dropped about 30%. In 2008, oil price dropped 70% after peaking out at $140. If we zoom in again on 2007-2008, you realize that global financial crisis already started. General market was selling off already, but oil price continued to run up. And it's only towards the depths of the whole global financial crisis that oil price finally crashed. That plunge was about 70% and very scary because it was only from June 2008 all the way to January 2009, which is just 6-7 months. Now, if you ask me which would be the more likely outcome this time around, my best guess is that it will be closer to year 2000, a drop of 30% at most, than in 2008 where it dropped 70% drastically. I believe personally that now we mirror a phase that's closer to the tech bubble than the banking crisis in 2008. Keep in mind again, in 2008, China was driving growth also. China was doing a lot of industrial output. So the consumption of commodities or the strong demand was created by industrialization in BRIC, Brazil, Russia, India, China. This time around, it's not really a demand problem. It's a chronic underinvestment for years into commodities as a sector. And then this war in Ukraine, whereby Russia's oil is now off the markets. So that's a supply problem. I believe that a 70% crash, like what we see in 2008, is going to be a lower odds outcome. And speaking to here, if you ask Warren Buffett about his thinking process, he would also say that when he buys Occidental and buys Chevron, he doesn't know where the oil price is. I guess that's a politically correct answer to make. His words impact a lot of things. But when he makes certain assumptions on the business valuation, he also needs to make a range or a guess in terms of the oil price, correct? Because that impacts profitability. And that's why my guess is he's thinking that oil price would drop temporarily, that's okay. But the long-term forecast for oil, at least in the foreseeable future, is going to be high. That leads to the next question, which is on recession. I've been harping on recession quite a bit. I believe that the odds are very, very strong. If you were to look in terms of latest numbers, this is actually published on the US government website, that the probability of recession seems to have increased past 50% already, according to this statistical calculation. A recession is only confirmed on hindsight, and how severe it is still anybody's guess. So let's not put too much weight in terms of guessing, let's put more weight in terms of approaching investing properly. And that's where I'll drive on to palm oil sector, because I've been looking a lot in palm oil stocks. Let's look at what happened in 2007-2008. You see that palm oil actually rose in tandem with crude oil price, correct? And it actually peaked out in February 2008. Bear in mind again, that's when everything in the global financial landscape was already starting to burst. Lehman Brothers actually went bankrupt in September 2007. Then palm oil made a second peak in June 2008, but together with oil price, it crashed for the subsequent few months ahead. It bottomed out actually way earlier in October 2008, losing about 50% from its peak. Now subsequently, prices stabilized about 2,000 plus Malaysian ringgit per ton. That is probably closer to a fair value. It goes to show that commodity markets can swing wildly. Subsequently, palm oil prices recovered and stayed significantly high for the foreseeable years ahead. If we look in terms of Singapore listed palm oil players, First Resources, Golden Agri, Bumi Agri. You see over here, this chart, First Resources price earnings ratio right now is about 12 times, with dividend yield of 3.63%, pretty respectable. Bumitama Agri, which is the light blue line over here, listed in 2012 when palm oil price was relatively good. So a good time to list, but it does not have the track record for me to dive a bit further and share with you my train of thought. For Golden Agri, you realize that share price stayed suppressed for years, correct? Because Golden Agri was loss-making for several years, and it goes to show, so in the same sector, a good company can show good share price, a lesser-run company will show a poor share price performance. Let's zoom in specifically on First Resources and stress test our mindset on what could come ahead. As I mentioned just now, palm oil price at the second peak in June 2008, and what we can see is this horrific crash, correct, over here for share price. If you had invested here at the very bottom, we have lost 80%. Absolute panic, correct? Now, I've seen quite a few questions coming on in this community. Hey Josh, are you buying more palm oil stocks or not? And I'll answer that question right now and give you a bit more context to things. Right now, I'm not buying more commodities already. It's already too big a sector in my entire portfolio, ranging about 30%. So how much I've invested is different from how much you've invested. When I've invested is also different from when you invest. So when I'm not buying more, it doesn't mean that you cannot buy. There are a lot of factors that will impact your whole investment outcome. At this point of time, if I need to prepare myself for a worst case scenario, I also think 80% decline in terms of share price for a good company, can I tolerate that? To answer that in my gut feeling, that is a very scary proposition. That will be easily a few 100,000 loss in terms of my P&L. And at this moment, I think doubling down, pretending to be very courageous and hoarder is not the right approach that I'll be taking. I've already a significant over allocation. Right now, my mentality is to prepare for survival. So hopefully that answers your question, and hopefully if you are starting at a later position, you are much more at an advantageous position. What I'm aiming for is not, you see, if you've invested at the bottom all the way to somewhere to the top, you have easily made a 6-bagger in a few quick years. That looks nice. That is what catchy advertisement titles tell you, or you are safe investing this. But don't assume the journey is an easy one. What I'm focused on is if I'm really indeed here and a recession hits, worst case scenario, I want to prepare myself for it. I need to make sure I can survive from here to here and still make a 66% gain in a couple of years. That is still a fantastic outcome already, and it depends a lot on me not making wrong decisions and not getting over greedy. Hopefully I've answered some of the questions and showed you the way forward. Again, if you have benefited from this discussion, smash on like, leave your questions in the comment section below. Smash on subscribe, especially if there are new updates coming on. I would like to notify you of them. With that, I sign off. Invest safe as always. Take care and goodbye.